If you are retired or you are getting close to retirement, there is one 2026 issue that could quietly drain money out of your monthly budget without you even realizing what happened until it is too late. And the problem is not always a scam, not always inflation, and not even always a benefit cut. In many cases, it comes down to a rule that looks simple on paper, but in real life, it catches retirees completely off guard. And when you combine that Social Security rule with the way IRS taxes and withholding work, the result can feel like your retirement income is being squeezed from both sides. So today, we need to talk about why some retirees are suddenly finding themselves short on cash, why some people are seeing their Social Security checks reduced or their tax bill rise, and what you need to do right now if you want to protect your money in 2026. Because here's the truth, a lot of retirees think once they start collecting Social Security, the difficult part is over. They think the system is automatic. They think the check amount they see is the amount they can count on. They think if they are retired, then working a little on the side won't really matter. And they think taxes will somehow be smaller in retirement just because they're older. But that is exactly where people get blindsided. In 2026, Social Security beneficiaries are receiving a 2.8% cost of living adjustment, and the retirement earnings test limits also changed. If you are under full retirement age for the entire year, the earnings limit is $24,480, and Social Security says $1 in benefits can be withheld for every $2 you earn above that limit. If you reach full retirement age during 2026, the higher earnings limit for the months before that birthday is $65,160, and the withholding rate is $1 for every 3 above the limit. Beginning with the month you reach full retirement age, there is no earnings limit. Source. Now, that sounds technical, but let me put it in plain English. Imagine you retired early. Maybe you filed for Social Security at 62 or 63 because you wanted income coming in. But then prices stayed high, property taxes went up, groceries cost more, insurance premiums kept rising, and suddenly your retirement became part retirement and part survival strategy. So you picked up a part-time job. Maybe you started consulting. Maybe you drive a few days a week, help a local business, or do seasonal work during the holidays. You're not trying to get rich, you're just trying to stay afloat. And that's exactly where the trouble starts, because many retirees do not realize that Social Security has a work-related earnings test before full retirement age. The system looks at your wages from a job or your net earnings from self-employment. If your earned income goes above the annual limit, Social Security can withhold part of your benefits. To the retiree, this feels like losing money. One month the check is there, another month it is smaller, or a payment is held back, and suddenly the household budget is under pressure. This is especially dangerous because retirees often plan their year backwards. They look at the benefit amount first, they build their bills around that number, then later they decide to work for extra cash. But the earnings rule does not care about the order of your decisions. Once your earnings cross the limit, the benefit reduction formula can kick in. That means the extra income you were counting on may not feel like extra income at all. It may simply replace money you thought Social Security was going to pay you anyway. And this is where the headline gets real. Retirees are not just losing money because of one line in a policy document. They are losing flexibility. They are losing predictable cash flow. They are losing the confidence that comes from knowing exactly what will hit their bank account each month. And in retirement, uncertainty is expensive. Now, to be fair, Social Security does explain something very important. Benefits withheld under the earnings test are not necessarily gone forever. The agency says that once you reach full retirement age, it recalculates your benefit to give you credit for months when benefits were reduced or withheld because of excess earnings. In other words, this rule can be more of a timing hit than a lifetime confiscation, but for a retiree living month to month, timing is everything. If your utility bill is due now, if your rent is due now, if your prescription refill is due now, money you might recover later does not solve the immediate problem.
That is why so many people get frustrated. They hear someone say, "Don't worry, you get credit later," but what they are actually experiencing is a cash crunch today. And retirement is full of today problems. Insurance premiums do not wait. Mortgage lenders do not wait. Credit card companies definitely do not wait. Now let's bring the IRS into this, because this is where the second part of the squeeze happens. A lot of retirees assume that if Social Security is already complicated, taxes must somehow sort themselves out automatically. But that is not how it works. Social Security itself says you may owe federal income taxes on your benefits if your combined income exceeds $25,000 a year for an individual filer, or $32,000 for a couple filing jointly. And Social Security allows you to voluntarily withhold only 7%, 10%, 12%, or 22% from your monthly payment if you choose to set up federal tax withholding. Source. Think about what that means. First, many retirees do not set up withholding at all because they assume their taxes will be small. Second, even if they do set it up, they may choose a percentage that does not match their actual tax situation. Third, if they are also working, wages from that job are subject to income tax withholding, Social Security tax, and Medicare tax, even if they are already receiving Social Security benefits. The IRS specifically reminds seniors that earned wages are still subject to withholding for income tax, Social Security tax, and Medicare tax, even when the taxpayer is receiving benefits. Source. So now you can see the trap. A retiree starts benefits early, then they keep working. Their earnings may trigger the Social Security earnings test. At the same time, their wages are taxed. Their total income may also make some of their Social Security benefits taxable. If they fail to set up enough withholding or any withholding at all, they can end up shocked at tax time. So from their point of view, money disappeared in 3 ways: reduced benefit payments, taxes on wages, and a possible tax bill tied to overall income. That is why this issue feels bigger than a simple Social Security adjustment. It becomes a budget ambush. Now, some people may say, wait a second, didn't the IRS announce a new enhanced deduction for seniors? Yes, it did. The IRS says that from 2025 through 2028, eligible taxpayers age 65 and older may claim an additional $6,000 deduction per person, or up to $12,000 for a married couple if both spouses qualify, subject to income phase-out rules above $75,000.
If $2,000 comes in, but only $1,700 is really available after taxes, premiums, and withheld amounts, then your lifestyle is built on $1,700, not $2,000. The problem is that many retirees budget as if gross income is spendable income. That mistake may not show up right away, but eventually it shows up in the form of credit card balances, skipped savings, or a tax bill that arrives when cash reserves are already thin. And the emotional side of this is real too. A lot of retirees feel embarrassed when this happens. They think they should have known better. They think they made a rookie mistake. But honestly, the system is confusing. Social Security rules, IRS thresholds, withholding choices, deductions, work income, Medicare effects, and reporting requirements all overlap. Even financially responsible people get caught by this because the rules live in different places and hit at different times. That is why the smartest retirees do not just ask, how much is my benefit? They ask, how much of this money can I actually keep and what could make it change? That question can save you thousands. So what should a retiree actually do right now? First, if you are collecting Social Security before full retirement age and you are working, estimate your earned income for the full year immediately. Not next month, not at tax time, right now. If you're close to the limit, know that even a small increase in hours or one extra contract could push you over. Once you know where you stand, you can decide whether the extra work is truly worth it after considering possible benefit withholding. Second, separate earned income from unearned income on paper. Do not just write income. Divide it into wages, self-employment income, pension, IRA withdrawals, annuity payments, investment income, and Social Security. Why? Because each category can affect your retirement differently. Some impact the Social Security earnings test, some affect taxes, some affect both. Until you separate the buckets, you can't see the real picture. Third, review whether federal tax withholding from Social Security makes sense for you. Social Security says you can request withholding at 7%, 10%, 12%, or 22% of your monthly payment. If you have no withholding now and your combined income may trigger federal taxes on benefits, waiting until tax season could be painful. A smaller amount withheld during the year often feels much easier than one large bill all at once. Fourth, don't assume the enhanced deduction for seniors solves everything. Yes, it may help reduce taxable income for many older taxpayers between 2025 and 2028, but your eligibility depends on age and income rules, and it's only one piece of the tax puzzle. It should be viewed as a planning advantage, not a magic shield. Fifth, remember the timing rule around full retirement age. Social Security says that beginning with the month you reach full retirement age, your earnings no longer reduce your benefits no matter how much you earn. For someone close to that milestone, the timing of when you claim and when you work can make a major difference. This is why one of the most expensive retirement habits is acting first and calculating later. People claim first and analyze later. They work first and track income later. They spend first and plan for taxes later. And retirement punishes that pattern. Let me give you a realistic example. Suppose a retiree is 63, collecting Social Security and earning part-time wages. They think, I'm only making extra money for necessities, so it shouldn't be a big deal. But by the end of the year, their wages exceed the annual earnings limit. Social Security withholds part of the benefit. Then, because they also had other household income, some of their benefits become taxable. They didn't set up voluntary withholding from Social Security because they assumed retirement income meant low taxes. Then, tax season arrives, and now they owe more than expected. In their mind, retirement stopped feeling secure, not because one giant disaster happened, but because several smaller rules all hit the same wallet. That is the real story behind headlines like this. It's usually not one catastrophic event, it's a chain reaction. And chain reactions are dangerous because by the time the final bill arrives, the original mistake is months behind you. Another important thing retirees need to understand is that retired is not always the same as treated as retired under the rules. You may feel retired because you left your main career, but if you're still generating earned income before full retirement age, the earnings test can still matter. So don't let the word retired lull you into thinking the work rules no longer apply. Also, be careful with assumptions based on what happened to someone else. Your friend may be working and still getting full benefits because they already reached full retirement age. Your neighbor may owe little tax because their income mix is different. Your sibling may have more investment income and less wage income, which changes how the rules hit them. Comparison is one of the fastest ways to misunderstand retirement planning. Your numbers are your reality. And the 2026 environment makes this even more important because the cost of living increase, the earnings thresholds, and the tax guidance all move together in ways that can create false confidence. Some retirees see a COLA increase and assume they're safely ahead, but a higher check doesn't automatically mean stronger financial security if work income, taxes, and withholding decisions are working against you. Social Security's 2026 fact sheet shows the average retired worker benefit rising with the 2.8% COLA, but that bigger headline number doesn't tell you what your household keeps after all the other moving parts are considered. So, here's the bottom line. The real 2026 alert is not that retirees suddenly face one mysterious new penalty out of nowhere. The real alert is that many people are underestimating how the Social Security earnings test and IRS tax rules can interact when they keep working before full retirement age. One rule can reduce current benefit payments, another rule can create taxes on income and benefits. A deduction may help, but not always enough to fix poor planning. And when retirees don't see the interaction early, they end up feeling poorer even while technically bringing in more money. That's the paradox. You can earn more and feel worse. You can receive a COLA and still feel squeezed. You can think you're doing the responsible thing by working and still end up frustrated when the system takes a bigger bite than you expected. So, if you're a retiree or if you have parents, relatives, or friends receiving Social Security, this is the warning they need to hear. Don't focus only on the benefit amount. Focus on the full money flow. Know your earned income, know your filing status, know whether taxes are being withheld, know when you reach full retirement age, and know which income sources affect the earnings test and which don't. Because retirement mistakes are rarely expensive because they're dramatic. They're expensive because they're quiet. And quiet mistakes are the ones that drain accounts the fastest. If there's one message to remember from all of this, it's simple. In 2026, the retirees most likely to lose money are not always the ones with the lowest income. Often they're the ones who assume the system is automatic and never stop to calculate how Social Security and IRS work together. Don't be that retiree. Run the numbers before the check changes. Review withholding before tax season hits. And if you're still working while collecting benefits before full retirement age, treat every extra dollar of wages like a planning decision, not just extra income. Because in retirement, what matters is not just what you earn, it's what you keep.